$1,142,857. That is the number Howard Marks's framework demands you deploy today to generate $5,000 in passive dividend income every single month for the rest of your life without ever touching the principal. Not $3,000, not $4,000, $5,000 a month, $60,000 a year, forever. Here is what makes this number explosive. Howard Marks, co-chairman of Oaktree Capital Management, just published a memo titled, quote, "What's Going On in Private Credit?" end quote, in April of 2026. He warned that $2 trillion has poured into opaque private lending vehicles over the last 15 years, and underwriting standards have collapsed. $2 trillion chasing yield. He calls it a yield-hunting gold rush built on hidden risk. So the question is no longer where do you find income? It is where do you find income that is not going to vaporize when the next credit cycle turns. In the next 13 minutes, I will walk you through Marks's framework, the 8 stocks that satisfy his quality filter, the math on $5,000 a month, the safety analysis proving these payouts survived 2008 and 2020 without a cut, and the counter-argument. This matters because the era that funded easy retirements through capital appreciation alone is over. Here is the framework. The foundation of everything that follows is a single Howard Marks memo, December 2022, Sea Change. In that memo, Marks wrote, quote, "I consider that 40-year, 2,000 basis point decline in interest rates the most impactful event in the financial world in the last half-century, but one that has received inadequate attention." End quote. Read that again. 2,000 basis points, from 1980 to 2020. That tailwind subsidized everything. Speculative growth stocks, money-losing companies, leveraged buyouts, the entire structure of modern finance. And it is over. Marks then paraphrased Warren Buffett, quote, "Now that the tide has gone out a bit, we have caught a glimpse of some who were swimming naked near shore," end quote. So, who is swimming naked? The over-leveraged, the speculative, and increasingly the private credit industry that absorbed $2 trillion from investors hunting yield in the zero-rate era. His prescription. Marks describes intelligent income investing as a, quote, "negative art," end quote. The objective is not maximum upside. It is to systematically eliminate the probability of unrecoverable loss. That philosophy is what we are operationalizing here, translating Marks's macro warning into a portfolio of dividend equities with transparent free cash flow coverage, investment-grade balance sheets, and decade-plus records of raising distributions through every recession. Here is the math. $60,000 per year divided by your blended yield equals the capital you need. At 3%, $2 million. At 4%, $1.5 million. At 5.25%, $1,142,857. At 6%, $1 million flat. Anything above 6% is the yield trap zone, so the optimal target is 5.25%. That requires $1,142,857 spread across 8 stocks at $142,857 per name. Now the 8 stocks. Stock number 1, Enterprise Products Partners, ticker EPD, Energy Midstream. Current share price $38.03. Current yield 5.78%. Annual distribution $2.20 per unit paid quarterly. Dividend growth streak 25+ consecutive years. Credit rating BBB+ from Standard & Poor's, one of the highest in midstream. Enterprise is a toll bridge for hydrocarbons. Fee-based revenue regardless of oil prices. That is the durability Marks demands. Stock number 2, Chevron Corporation, ticker CVX, Integrated Oil and Gas. Current price $192.28. Current yield 3.78%. Annual dividend $7.12. Dividend growth streak 37 consecutive years. Credit rating AA-. Chevron's payout ratio sits below 50% in mid-cycle pricing, and free cash flow surged over 35% year-over-year on record Permian production. Stock number 3, Realty Income Corporation, ticker the letter O, retail REIT. Current price around $60.51. Current yield 5.09%. Annual dividend $3.08 paid monthly. Dividend growth streak 30+ consecutive years. Credit rating A-. Realty Income operates under triple net leases. Tenants pay the property taxes, insurance, and maintenance. That transfer of inflation risk to the tenant is the textbook definition of pricing power. Stock number 4. Verizon Communications, ticker VZ Telecom. Current price around $45.23. Current yield 5.88%. Annual dividend $2.66. Dividend growth streak 17 years. Payout ratio under 60% of free cash flow. In 2024, Verizon generated $19.8 billion in free cash flow. People will give up coffee before they give up their phone bill. Stock number 5. Altria Group, ticker MO Tobacco. Current price around $68. Current yield 5.78%. Annual dividend $3.93. Dividend growth streak 50+ consecutive years. That makes Altria a dividend king. Combustible volumes have been declining for decades, and yet revenue and free cash flow continue to climb. Why? Because Altria can raise prices on an inelastic, addicted consumer base faster than volumes decline. Stock number 6. Bristol-Myers Squibb, ticker BMY. Pharmaceuticals. Current price $57.38. Current yield 4.33%. Annual dividend $2.52. Dividend growth streak 17 years. Credit rating A-. Payout ratio just 42% of earnings. Healthcare spending is decoupled from the economic cycle. People do not stop taking blood thinners because the S&P is down 20%. Stock number 7. Prudential Financial, ticker PRU. Life insurance. Current price $98.11. Current yield 5.73%. Annual dividend $5.60. Credit rating A. Payout ratio only 37% of earnings. This is the cleanest expression of the sea change thesis in the portfolio. When rates rise, life insurers like Prudential reinvest their massive policy float into higher-yielding fixed income. Higher rates are a structural tailwind, not a headwind. Stock number 8. Main Street Capital, ticker MAIN. Business Development Company. Current price $56.15. Current yield 5.60%. Annual dividend $3.12 paid monthly. Dividend growth streak 11 consecutive years. Marx has warned about opaque, illiquid private credit. Main Street Capital is the transparent, publicly regulated alternative, targeting lower middle market companies with senior secured debt. You get the premium yield of private credit with full daily liquidity and visible coverage. 8 stocks, equally weighted, $142,857 per position. Combined annual dividend income $60,000. Now the cash flow calendar. Realty Income and Main Street Capital both pay monthly, so you receive distributions every single month, 12 months a year. The quarterly C Corp dividends layer on top to amplify specific months. January, Altria pays. February, Enterprise Products, Bristol-Myers, and Verizon. March, Chevron and Prudential. The pattern repeats each quarter. Now, let me prove the safety, because none of this matters if these dividends get cut. Every one of these 8 names has a verified dividend growth streak of at least 11 years. Several extend beyond 25. Altria sits at 50+. Every board here successfully navigated the 2008 global financial crisis and the 2020 pandemic. They did not cut. They did not suspend. They raised. Free cash flow coverage tells the same story. Prudential at 37% of earnings. Bristol-Myers at 42%. Verizon at under 60% of free cash flow. These are not stretched payout ratios. These are reservoirs. Stress test. Imagine a 20% revenue contraction. Realty Income's tenants are legally required to pay rent under triple net leases. Enterprise Products collects volume-based toll fees, not commodity premiums. Bristol-Myers and Prudential, with their 37 and 42% payout ratios, would maintain their dividends from internal cash generation alone. Now the risks. Risk number 1, interest rate sensitivity. If the Fed is forced to hike further to break entrenched inflation, Realty Income and Verizon are the most exposed. Their valuations move inversely to the risk-free rate. Risk number 2, sector-specific headwinds. Altria faces existential, slow-moving regulatory pressure from the FDA. Chevron and Enterprise Products face the long-term energy transition. Risk number 3, the yield trap. Any stock yielding 8% or higher without explosive cash flow growth is signaling distress. The 5.25% target is deliberate. Tax efficiency. $5,000 a month is gross. Net depends on placement. Chevron, Verizon, Altria, Bristol-Myers, and Prudential issue qualified dividends, taxed at favorable capital gains rates. Realty Income and Main Street pay ordinary income, so they belong inside an IRA. Enterprise Products is an MLP issuing a K-1 and distributing tax-deferred return of capital. Strategic Placement, REITs and BDCs in the IRA, C-Corp, and the MLP and taxable can preserve thousands annually. Now, the counterargument. The Boglehead camp argues fixating on dividends forces suboptimal capital allocation. Every dollar paid out as a taxable dividend is a dollar the company cannot reinvest. Warren Buffett himself prefers tax-efficient buybacks. By forcing capital into mature dividend payers, you potentially sacrifice the compounding power of dominant growth firms. And there is a macro risk. If the sea change era produces a permanent 5 to 6% federal funds rate, a 5.25% yield offers zero risk premium over a risk-free treasury. Share prices fall. Yields rise. Painful. These are real considerations, but Marx's response is consistent. The objective is durable cash flow with avoidance of unrecoverable loss. Cross-reference. Berkshire Hathaway is sitting on $397 billion in cash, 14 consecutive quarters as a net seller. Greg Abel took the CEO role on January 1st. The Buffett indicator hit 228% in May. Michael Burry disclosed a $1 billion bet against the AI capex bubble before deregistering Scion. Stanley Druckenmiller exited Meta. GMO is forecasting negative 2.7% real returns over the next decade for U.S. large cap. The smartest allocators are hoarding dry powder and demanding here and now cash flow. That is exactly what this 8-stock portfolio delivers. So here is the 3-step takeaway. Step 1. Recognize the system you are operating inside. The 40-year tailwind that subsidized capital appreciation is over. Income from durable assets is not optional anymore. It is the new baseline. Step 2. Audit your own portfolio against the filter. Investment-grade credit. Payout ratio under 75% of free cash flow. 10-plus year dividend growth streak. Free cash flow coverage of 1.3 times the dividend in elastic, recession-resilient revenue. If your holdings cannot survive that filter, you are exposed to the yield trap Marx is warning about. Step 3. Build optionality. You do not need $1.14 million on day one. You need a system. Start with one position. Scale into the 8 names methodically. Reinvest distributions until you reach the income you need. If you want to see which stocks the smartest investors are accumulating right now and which ones they are quietly liquidating, watch the next video on screen. The rotation happening in the institutional landscape is the largest in 15 years, and most retail investors have no idea. I am not a financial advisor. None of this is personalized financial advice. Do your own research. Consult a licensed professional before making any investment decision. Numbers cited reflect public market data as of early May 2026, and yields, prices, and credit ratings change continuously.